Hey everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week. We're going to talk about the Fed, we're going to talk about inflation, interest rates, recession probabilities, and more. So let's start out by jumping in, talking about that Fed meeting, and try to answer this question: was that the last hike? So before we get into that, this is the tweets that I like to put out before each and every Fed meeting and essentially predicting what the Fed will do. And how do I get these right? So this time around, I said that the Fed would hike 25 basis points. And a lot of people responded saying, no, they're not going to hike at all, or they're going to hike 50 basis points. How did I know it would be 25? I don't have any special predictive powers. All I do is look at what the market's expectation is heading into the meeting, and what was priced in was 25 basis points, and that's exactly what the Fed does. And the Fed doesn't like surprises. So over the last decade, the Fed has pretty much done every single meeting what the market has expected it to do heading into that meeting. And before that, there were times where the Fed would do something different. There would be a surprise a rate hike or a surprise rate cut. But in the last decade, really, we haven't seen that. It's been whatever the market's expectation is, the Fed does. So at some point, I'll get this wrong because the Fed will do a surprise, but up until that point, it seems to be the status quo. It's a pretty good bet to say that the Fed's going to do what the market's expecting it to do. Now, where does that bring us in terms of hikes? Well, that's 9 rate hikes now, 475 basis points increase since the Fed started hiking rates only a year ago in March of 2022. And this is the fastest rate hiking cycle we've seen since the early 1980s. So very fast in a 1 year period, the Fed is almost hiking 5%, going from zero to a new range of 4.75 to 5%. So that brings the Fed funds rate, if we're looking at the lower bound, that 4.75, up to its highest level since September 2007. So getting there and getting there very quickly. And really, what everyone was looking at is really the change in language. They wanted to see something from the Fed to suggest that there wouldn't be many more rate hikes. And that's exactly what they got. The Fed took away that statement saying that they anticipate ongoing increases in the target range. So that's been there for a while. And they changed that to say they're going to closely monitor incoming information and assess the implications for monetary policy. And they're going to anticipate some additional policy firming may be appropriate. So some additional policy firming may be appropriate. You can translate that to saying, well, it may be and it may not be. So they're going to take what happens, let's say, in between now and the next meeting in early May and make that decision. And so possibly the Fed could be done. And indeed, that's what the market is suggesting, that the Fed is done with rate hikes for this cycle. And again, caution to read too much into this because this changes wildly from data point to data point and week to week. But the market's currently saying the Fed is done hiking rates and that they're actually going to start cutting rates sometime maybe in June or July of this year. And they're going to continue cutting rates all the way throughout the rest of the year and into 2024. So why would the Fed be cutting rates at that point? Well, we're going to talk about that. But first, why is there now room for the Fed to pause? So before we're going to get rate cuts, the Fed has to stop hiking rates. And I think there's 3 pretty good reasons for the Fed to pause. So looking at that May meeting, they're going to be pointed to, I think, these 3 things if they're going to pause: the inflation data, which continues to trend lower. So that's really number one. They're hiking rates, obviously, to fight inflation. So if inflation becomes less of an issue, they have room to slow down, to pause, to reassess, and hopefully that inflation rate will continue to come down, and then they won't have to resume hiking rates at a later point. 2, we have this new development of the banking crisis, which they alluded to in their statement, saying that it's going to tighten financial conditions. And what they're basically saying there is that's going to lead to more of a slowdown, perhaps in the economy. That's a deflationary type of event. So that's going to put additional pressure on that inflation rate, bringing it down. So banking crisis, let's say banks are going to lend less. It's going to lead to less economic activity, less demand, less growth, less inflation. And lastly, on the economy, we're seeing increased evidence of potential slowdown. We're going to talk about retail sales in a little bit. But a number of signs of leading indicators continue to point to an economic slowdown. while the employment data isn't there just yet, I think there's enough other data to suggest that the Fed will likely be talking about that or thinking more about that in the months to come. So, three pretty good reasons to pause. But let's start with that lower inflation and just look at where the Fed funds rate is now in relation to the inflation data that the Fed likes to look at. So, now we finally have a Fed funds rate, if we look at the lower bound here, above the core PCE inflation rate. And the core PCE is something that the Fed always talks about being their preferred measure of inflation. So, we finally have tight monetary policy where we have that Fed funds rate above that inflation. And if you remember in these videos in the past year, I've been saying the Fed is going to continue to hike most likely until we get above that rate of core PCE. Well, now we're above it. Uh, could they do one more? Certainly. But they're at finally at the point where they have now room to say we're going to pause and perhaps reassess with the expectation that this core PCE is likely to come down, let's say, in the coming months. And if we look at overall CPI, well, still above that core PCE level, but moving down pretty quickly now. We have a downward trend since last June. So last June, inflation peaks at 9.1%. We're down to now 6%. And really the expectation is this is really going to show significant declines in the next few months because that year over year comparisons are really going to become much more favorable. We'll talk about that later in terms of commodity prices. But looking at the major components of that inflation report, what really stands out versus last June? Well, pretty much the majority of the major components have a better inflation reading than last June. If you look at medical care, apparel, used cars, food away from home ticked up a little bit, but new cars down, food at home finally starting to move down, electricity, gas utilities, gasoline, fuel oil. So all of the energy components down since last June. The big one that stands out in terms of what hasn't gone down since last June is that shelter component. And I say it's a big one because it's 34% of the index is just that shelter component. So most people, their biggest expense by far is that housing expense. So shelter continue to move up, but as we've talked about, shelter's a very lagging indicator. So they're taking into account the data months after it changes. And here we're showing the comparison of shelter CPI, which hit 8.1% in February. That's the highest since the early 1980s, versus actual rents. So rental data from apartment list, their year over year rate of change is down to 3% and has been moving lower for some time. So, as I've been saying, shelter CPI has been playing catch up, and certainly there might be a little bit more to go. But I expect in the next few months, at some point, you're going to see a rapid slowdown in that rate of increase, and perhaps it starts moving in the other direction, assuming that rents continue to trend lower in terms of their growth rate. We've even seen an outright decline, let's say, over the last 5 months in terms of rent. So think this will be the most important factor to watch for that core rate of inflation. Obviously, shelter, huge component there, but even the overall, once shelter shifts, you're going to see that overall CPI very quickly start to move lower. So, elsewhere on the inflation front, we got import price data now down year over year. So, again, this spiked higher, was leading overall inflation rates, and now coming down and negative on a year over year basis. So, that should start to filter into the prices of goods, obviously, and be helpful in terms of inflation there. And lastly, looking at producer prices continue to trend lower, similar CPI, but has been a little bit faster, let's say, on the way up and now faster on the way down. So perhaps again, similar to import prices, that's a leading indicator for CPI and saying this time that we're going to see lower rates of CPI in the months to come. It's the lowest since March 2021 for this producer price index. So all of these data points, good for the Fed to say we can pause. Suspect that when we get to that May meeting, you'll have additional evidence here. Both CPI and PPI should be even lower at that point if you're looking at the data points between now and that next meeting. And that should give the Fed enough comfort if they want to pause. But let's talk about what the Fed's done so far in terms of this Fed put. So what is the Fed put? The Fed put is this idea that when market prices fall pretty rapidly, and too fast for the Fed's comfort, they step in to do something to try to change the psychology and to try to prop up asset prices and build back confidence in markets. And in terms of prices falling very quickly, it wasn't the overall market this time around. It was really limited to the regional banking sector. But what we saw there is just one of the most rapid declines that we've seen in history. So if we look at the 2 week declines in this regional bank ETF, 28% decline. That trailed only March 2020 in terms of ranking the worst 2 week declines in history. And if we look at all of these other data points on here in terms of large declines in the banking ETF, what was the Fed doing during these times? They were easing monetary policy. So to say that the Fed isn't looking at this today and they're not likely to do something, I think would be ignoring the history behind it. And indeed, the Fed is already doing quite a lot behind the scenes. So while they still did hike interest rates, what they did so far is provide a massive amount of liquidity to these banks in the system. And if we look at the discount window, so this is like the Fed's, the lender of last resort. Banks go to the discount window, borrow. We saw a over $150 billion spike in discount window lending in just 1 week, and that surpassed the record that was set in 2008 of I think around 112 billion. So pretty wide margin. We surpassed that. So the Fed is increasing their loans to banks, doing it a number of different ways. The mechanics don't really matter all too much, but the result of this is now the Fed's balance sheet is moving upward again. So we had, if you remember, that quantitative tightening where the Fed was letting those securities that it held on its balance sheet that it had purchased in 2020, 2021, massive amounts of quantitative easing, buying treasury bonds and mortgage bonds. So they were letting those roll off month after month. And we had a pretty sizable rate of decline here, 626 billion from the peak in the Fed's balance sheet in April 2022 to the low in March 2023 before Silicon Valley Bank failed. But with the bank failures, all of that changed. Fed is now lending directly to these banks, increasing the size of its balance sheet. In fact, the 392 billion increase in its balance sheet over the last 2 weeks is the biggest 2 week increase since March and April of 2020. So very quickly, Fed's reversing 60% of this decline. So very kind of methodical decline here in terms of letting these securities roll off. And then we have this potential crisis, and this Fed put is there. It's just providing liquidity. Now, some would argue this isn't the same. It's not quantitative easing because the Fed isn't buying bonds just yet. They're not buying mortgage bonds and treasury bonds, but the end result is the same. Fed is stepping in, providing a massive amount of liquidity, trying to change the psychology of market participants. And we'll see if that's enough. Now, what is the market saying in terms of, is this going to be enough? Market saying, no, not going to be enough. The Fed's going to need to not only increase its balance sheet via loans and swaps and other things, but the Fed is also at some point pretty soon going to have to start cutting rates. Now, this might be the wrong expectation, but as of now, market's saying Fed is going to start cutting rates at some point this summer, and they're going to continue to cut rates down to around 3% by the end of 2024. So market's saying the cycle has turned. The Fed is not going to just sit by and watch the banking crisis go on without trying to do something more than they've done so far. And so the market's expectation is they're going to come in and try to save the day again through interest rate cuts. And so the question will be, of course, is the market going to be right here, or are we going to have markets rebound? Let's say regional banks start to rebound, confidence comes back in, and then these expectations change to the point where the Fed is not cutting rates. They're going to leave rates higher for longer. I think that's going to be a back and forth. But at the very least, this argues for a potential pause at that May meeting. And then if you look at the last reason for that pause, I think we have to look at the yield curve and the action there. And this is really a function of what market participants are expecting in terms of those future rate cuts. we saw the quickest steepening of the yield curve. So we had the spread between the 10-year and 2-year Treasury yield spike 65 basis points over a 7-day period. We haven't seen a move that big in a 7-day period since the 2001 recession. And so how did that happen? It was really just a collapse in that 2-year Treasury yield. So you have 2-year Treasury yield really collapsing on the expectation the Fed's going to start cutting interest rates. So 2 years from now, that Fed funds rate is going to be lower. And you saw that 2-year go from 505, which was its highest level since 2007, and then very quickly decline 124 basis points, which was actually the largest 7-day decline since October 1987. So during the stock market crash back in 1987, you had saw yields going up pretty rapidly before the crash, and then the crash hits, the Fed cuts interest rates, and you start see yields come down rapidly. So um, the market is saying that the Fed is going to do something similar, at least for now. Again, if the data improves, if confidence comes back, regional bank stocks stabilize, deposit outflows are really stemmed, then that could change. But as of now, this is the current expectation. So if we look at that yield curve, what is that signal from steepening? So you've heard me talk about that inverted yield curve and how that's preceded the last 6 recessions in the US. Well, if we look at these recessions here in 1980 and the double dip in the early 1980s, in the 1990-91 recession, 2001 recession, 2008 2009 recession, and the 2020 recession, what you see here is an inversion in advance of each of these recessions. But then as you start to get in or closer to that start of the recession, what you see is a steepening of the yield curve. So the question is what we saw in the last few weeks the start of that steepening process. And how does that steepening process usually come about? Well, it's usually from the Fed, or the expectation that the Fed will start cutting interest rates, and you see that 2-year drop down pretty dramatically. So will this continue? I don't know. If it does, is it signaling something? Well, it seems, based on history here, that it likely is. It's kind of circular in a way, because if the Fed is seeing recessionary data coming, obviously they're more likely to cut interest rates. And if they cut interest rates, the yield curve is going to steepen if they cut interest rates rapidly. And so we'll see how it plays out. But certainly, yet another example of a signal kind of pointing to economic weakness here. So if we look at that leading economic indicators, we look at this every month. We look at the year over year rate of change, continues to get more negative. And just the last few times that we've seen it this negative, the economy was in or close to being in a recession. So this is not just the yield curve. They have other data points, obviously, in there as well. Housing is a component in there. We'll talk about that. But it's a number of indicators pointing to future economic weakness. The one I like to look at, because it's such a big part of the US economy, is consumer data and looking at retail sales. And importantly, again, you can't look at this retail sales number on a nominal basis. So you can't look at it without including inflation, because inflation's still obviously pretty high, even at 6%, well above the averages from the last 20 years. And if we adjust for inflation now, we have 6 consecutive months where that year over year rate of change of retail sales is negative. So you take out inflation, you adjust for inflation, and you have consumers spending less than they did a year ago. So to me, that's if that persists, obviously that's kind of often what happens during recessions. You have negative real retail sales for some period of time during a recession. Depending on how long and how deep the recession is, this could get worse, or it could improve. But this is something you typically see during a recession. We talked about a number of reasons why the US consumer might be starting to pull back, just from the fact that their savings rates have gone down so much. And at a certain point, they might start to worry about the future and not spend as much today. And also, credit had been increasing at a pretty rapid pace. So they might, at some point, given high interest rates on credit card debt and other loans, they might start to think twice or not have as much access to credit there. Those are two reasons why consumer spending might come down. And we don't yet have that other main reason, which is unemployment. We don't have that factor there just yet, but that's kind of behind the scenes. If that were to happen, obviously, then you have a full fledged recession on your hands. And lastly, in terms of economic indicators, this is one that's not going away. It's going to be here for many months until that affordability equation changes. Housing activity just is unlikely to see a sharp rebound because the demand is simply not there. And if we look at existing home prices now, we're now negative on a year over year basis, not a huge decline, but negative, a change nonetheless. We haven't seen that in over a decade. And so prices slowly coming down. Affordability still remains the major issue. And without mortgage rates really moving back down quickly, you need prices to come down to spur demand because people just can't get a mortgage given that high price of the home based on their current income. So you still have home prices up significantly, even though they've gone down in recent months, still up significantly from where they were before the pandemic, and people's incomes simply are not up anywhere near that much. So let's talk about blood on the streets. There's a famous saying that you want to buy when there's blood on the streets. And what that basically means is that you want to buy when there's fear and there's panic and there's pain in the markets. And we haven't seen too much of that in the past decade. If we're looking at bank failures and the total assets of bank failures, the combined assets of the bank failures from 2010 through 2021 were way less than just the two bank failures that we saw just recently. So we finally have some distress in the markets, but it's really concentrated so far in just a few institutions. But that created opportunity for others to come in and step in and buy some of those assets at a discounted price. And thus far, the market's saying that that price is going to be favorable to these companies that bought them. So New York Community Bank comes in and buys a bunch of Signature Bank's assets. First Citizens Bank comes in and buys Silicon Valley, some of their assets, and they're buying these assets presumably at a discount to their market value. And so you're seeing their share prices jump here. And this is the overall regional bank ETF for comparison, hasn't moved much at all. So you're seeing still pressure in that regional banking sector, still people saying what's really going to be the next shoe to drop. But you're seeing opportunity for some of the banks that are in a stronger position to take advantage of this dislocation. And then, of course, we had that big one here, which is kind of like a fire sale where UBS was persuaded, presumably by the Swiss government and the authorities there, to buy Credit Suisse. And so they purchased it in a stock deal for around $3 billion US. And we saw an initial jump of UBS stock, but it came in a little. But nevertheless, you didn't see a decline. So presumably, market participants at least saying this purchase of Credit Suisse and the details were pretty favorable, it seems, to UBS. They didn't take on a lot of the excess baggage. They don't have to assume a lot of the risk that was within Credit Suisse. So assuming that they can maintain the businesses and customers behind Credit Suisse, there's going to be some value there. Just a stunning collapse. This didn't happen overnight. Credit Suisse lost over 7 billion Swiss francs last year. So this wasn't a surprise. I know a lot of people were talking about and the Swiss authorities saying, and even within Credit Suisse, blaming this on the U.S. bank failures. But this had been going on for quite a while. It was really one executive high-level mistake after another at Credit Suisse, and they're bleeding money and they're bleeding confidence and bleeding customers and deposits, and the crisis of confidence has been building over the years. So UBS steps in, massive backstop by the Swiss National Bank to help facilitate that. So all evidence seems to suggest that the too big to fail concept is not just a U.S. thing, global thing. Credit Suisse assets just enormous, and they're saying it's too big of an institution. We have to find a solution. We're going to try to do whatever we can to kind of save the system. And so the question I think for the future will be, what's the what's the rationale to let these banks and businesses get so big that you become so dependent on them that they will need a bailout in the future? There has to be, I think, some foresight in terms of businesses get so big and so complicated, and at that point, the management can't oversee everything effectively, and so they're not only too big to fail, or to become too big to succeed. So not sure what the solution for that is, but to wait till it gets to a crisis level doesn't seem to be a prudent thing. But really fascinating that back in 2007, Credit Suisse was a $90 billion company. I put out a tweet that it was actually at the time a larger company than Apple, if you could believe that. Apple, of course, now biggest company in the U.S., over $2.5 trillion market cap. Credit Suisse was actually higher than it in 2007. This was a month before the first iPhone was released. So a lot can change in in this period of time since 2007, 2022. But in terms of what people are thinking the next shoe to drop is, I think within the banking sector, the one company people are most focused on seems to be First Republic, just given the size of the company, pretty substantial, and how quickly the stock has deteriorated and really not recovered as much as the other regional banks. So a number of things were done. JP Morgan and the Fed extended liquidity, a huge amount, tens of billions to First Republic. And then you had this 11 bank deposit of 30 billion. So you have all of these different banks, major US banks, the biggest banks in the US, saying we're going to try to instill confidence in the system by depositing our assets, a portion of our assets, into First Republic. 30 billion total. The bigger banks deposited more, the smaller banks a little bit less. I did a table here showing you the percentage of each of these companies' assets and deposits and cash that they put in to First Republic. So we'll see if this works. So far, it really hasn't. I think the stock is lower than when they did this. So thus far, I don't think it's had the intended result. Maybe people viewed it as not being big enough, or maybe this scared people even more. Not sure. But if we look at the stock of First Republic Bank, just a stunning turn of events very quickly here. You go back to its IPO, December 2010, 25.50 a share, and then just a tremendous run up, similar to Silicon Valley Bank, was one of the leading stocks in that regional banking sector over this last decade. Just huge increase in its share value, and peaks in November 2021, similar kind of the growth and tech peak. And since then, down 95% and hitting still near its all-time low. So while you've seen somewhat of a stabilization in a number of these regional banks, I think there's still that fear that First Republic is the next shoe to drop, and no one really knows what the deposit situation is there, and when it will hit a point where really they can't do anything but let it fail and have a bigger bank or someone else take over. So we'll see what happens there. I think until there's an explicit guarantee in the short run, you're still going to have the situation where if a bank has a high percentage of its assets in non FDIC insured deposits, then those people are still going to say, as they should have been doing before, well, maybe there's a risk here of me losing it, and maybe I won't get bailed out like Silicon Valley Bank and Signature Bank were, and maybe I should move first and then ask questions later. So it's really hard to stem that psychology in the short run without explicit guarantee, or without just complete transparency that this bank is going to be fine regardless of withdrawals. So it's hard to say that, because you get a huge rush of withdrawals, and very quickly a bank cannot be fine. They may have some liquidity there, but they don't have the ability to obviously lose 20%, let's say, of their deposits in a single day, right? They probably won't be able to meet that for very long. And even if they are able to meet that, well, then the question becomes, well, what is the bank's business going forward if they're losing this massive amount of deposits? Are they going to come back in the future? And a bank is worth what its ability to make money in the future is. So if they're making money off those deposits, those loans, those customers, and they're losing these customers, obviously the bank is going to be worth much less. So no predictions for me here, other than that it's unlikely, it seems, that there won't be some other bank that has a problem at some point here, stemming from this, just because we don't know. We don't see that daily flows of deposits. And no one suspected, a few weeks before Silicon Valley or Signature, no one suspected that they were about to go under. And people are talking about First Republic, but there's probably banks out there that no one's talking about that are at risk as well. So let's talk about deflation. And you probably haven't heard the word deflation very much. Obviously, it's all about inflation in terms of what the Fed's worried about and the average American's worried about. But if we look at household net worth, what we've seen actually is a deflation in net worth in 2022, the second biggest increase on record after 2008. So what we saw in 2019, 2020, 2021, record increases in net worth. And why are these going up so much? Well, simply stock market, housing going up significant amounts during that period of time. Housing being the number one asset for most Americans, most households. And so that driving a major portion of this. And then in 2022, you have stocks obviously going down, home prices not up very much, down actually on a real basis, but nominal still higher. So giving back some of these gains. And really, if you look at it in perspective, a pretty small portion of those increases given back. So this is over 45 billion, or over 45 trillion in combined increases from 2019 through 2021, and just a 4 trillion so far decrease in 2022. So question is, it's similar thinking in terms of wealth effect. People feel wealthier, they spend more money. That was the Fed's policy for a long time, to try to drive up asset prices, saying it was justified because it's going to help the economy. People are going to spend more money if they think they have more money. If their house has gone up, the value of their stock portfolio is going up. They're going to spend more money. Well, now we might see the opposite effect of this, with I think housing being the most important component. People, obviously, a direct consequence. If your house is lower in value, you're less likely to take out, let's say, a home equity line of credit, or you have less credit available to you. You might put less in terms of renovation or upgrade in terms of your house, so less spending there. But just psychologically, it's something that is there behind the scenes, where if people feel like their net worth is going down, they're likely to spend a little bit less. So that's a deflationary force, of course. So let's talk about paper hands. And this is kind of a crazy idea that came about during the 2021 mania and meme stocks, that there's these so-called diamond hands that were these traders in meme stocks, and they were saying they're never going to sell these stocks ever. So GameStop, AMC, and Bed Bath and Beyond came one of the leading meme stocks. Why it did, I'm not really sure, but it did. And they were saying, we're never going to sell these. Doesn't matter. We're going to hold on to these forever. Of course, that notion is absurd. You don't have a record of anyone's buys and sells, and they could sell that very next day. You would never know it. These are just people on a message board saying that they're never going to sell. And if we look at Bed Bath and Beyond, and we talk about this diamond hand concept, I think it's pretty obvious that people did sell. And so this was the meme stock mania over here. Bed Bath Beyond obviously had been going down for quite some time before that point in time, been losing money for a number of years here. But then the crazy thing is that all of that was ignored during the meme stock mania, and now it's back to reality. So here we are, Bed Bath & Beyond today below its IPO price. So it IPOs in June 1992. It's Market cap is around 288 million, and then it goes all the way up 20 years later to a market cap of 17 billion. Pretty incredible it got that high. I was surprised to see that. And then fast forward to today, we're now down under 100 million, 99.5% so far. So seems like it's headed towards bankruptcy. We'll see what happens in the next couple of weeks, but this is just another kind of healing, in my view, of the market in terms of that meme stock mania. Day by day is really wearing off. You're getting back to the reality of people valuing companies based on their net income, based on their cash flows. So that ultimately is a good thing, but never fall for that trap of diamond hands. And I'm not sure we'll see that again. Maybe we will, but that I think that mania is probably done for a while. The odds are not in your favor, so you wanna as an investor look for places where the long-term odds are in your favor. And if we talk about active mutual funds and trying to pick the best active fund out there, it's a thing that a lot of people try to do. They want to do. In theory, there are obviously active mutual fund companies that do well, and certainly in short periods of time, any given year, you're going to find a number of funds that outperform their benchmark. But as time goes on and you go to 3 years and 5 years and 10 years, and you look at the funds and you include the funds that have gone away, gone out of business, shut down because of poor performance, what you find is that very few mutual funds over a 20-year period beat their benchmarks. So the vast majority, over 90% in most categories, are underperforming the benchmark. And there was this old saying by Jack Bogle, the founder of Vanguard. He said, "Don't don't look for the needle in the haystack, just buy the haystack." Essentially, he's saying trying to pick that fund that's going to outperform is trying to find a needle in the haystack. Very hard to do. So just buy the whole haystack and you'll benefit from that growth. So if you buy that entire index and try, instead of trying to pick that winner, you're going to benefit in the long run by obviously saving on fees, but also not then picking a fund obviously that's substantially underperformed. So not only are you risking underperformance, you could be risking large underperformance, and this chart doesn't really show that. And so the odds just aren't in your favor. Can you do it? Of course, it's possible. You could get lucky, but how can you tell in advance 20 years before that fund is going to be one of the winners? Very hard to do. And this, I think, is an important lesson on diversification that we got from the Silicon Valley Bank thing. I don't think anyone's really talked about it so far, so I want to touch on this. There's just a lot of stock-based compensation in Silicon Valley Bank Financial. So if you worked at Silicon Valley Bank, as part of your compensation, you'd be receiving this annual award in stock. Depending on your position, you may have gotten X percent, and maybe more of the higher level management certainly would get more in stock. But I think the lesson here for investors is if you work at a company and you get this stock based award, often the question is, well, what should I do with it? Should I keep it all in there? I like the company. I think the company's doing well. And I don't see any reason to sell it. Some people say, I don't want to pay the tax on that. So there's a million reasons you'd say to keep that, and really the only reason to sell it is the risk that company is going to underperform, let's say a broad market index, or worse, the risk that company goes bankrupt. So you're adding additional risk in that you already work for this company, so you have exposure to that area. Now you're doubling down on that by having your savings or your retirement tied to that as well if you have a significant portion in stock. So for a long time, for people that worked at Silicon Valley Bank, they probably viewed this as a good thing, this concentration risk. If they had this stock, it was appreciating, especially during the mania in 2020, 2021. way above what the S&P 500 was doing. So it was probably, the equivalent of winning, the lottery in terms of you're working at this company's doing extremely well, and I'm getting this paid in stock, and that's doing really well. And at the end of 2021, you're probably feeling really good about that and saying there's really no reason for me to sell it. Things are looking great. It's a good thing that I didn't sell it and diversify all of these years, but very quickly, obviously, things change. And here we are today. This is showing you as of the close of the last day of trading for SVB, but this really has gone down to zero. So, an extreme example, but I think an important example. It's not to say that if you have stock that you need to sell everything. Everyone's situation is different, so they have to evaluate what percentage of their savings, assets are tied to this. But the lesson is, uh, don't put all your eggs in one basket. You probably want to diversify. It's probably the odds of you being at a company that for a long period of time outperforms an index is just very low. Similar to the odds of you picking any given stock and outperforming index, very low. Not impossible. Of course, there's plenty of people that have worked at Apple and Google and Amazon over the last decade and done extremely well by holding the stock. But the vast majority of people who do that are not going to have that similar outcome. So it makes sense to at least pursue some diversification strategy just in case, because by the time this type of risk presents itself, and it doesn't have to be this extreme, of course, it doesn't have to be a bankruptcy, a total collapse, but by the time you get to that point, well, then it's too late to really do something about it. And anyone who's had shares in Silicon Valley Financial and all of a sudden very quickly it stops trading, well, now you can't do anything about it. So the time to think about diversification, the best time is when you don't need to be thinking about it, when that asset class or security is doing extremely well. And so this is a lesson we learn all the time with concentrated positions. They can be extremely beneficial on the way up, but it's only when risk presents itself that you see the problems with concentration. So I want to end with something positive, like we often do. This is really helpful in terms of the inflation data that we're getting from the commodities market. And if we look at commodities, what a scare that we had last year in March. It really looked like we were just going to see commodities continue to push higher. All major commodities were hitting highest levels in a long time. And you had a number of factors pushing prices higher. And now we're just seeing the opposite situation. Commodity index recently now down 37% from that peak last March, and the biggest year over year declines we're seeing since May 2020. And so if we look at these commodities, these are all the major commodities, and we look at where we are today versus a year ago, what a difference here. So a year ago, almost every single commodity is up and up big, and higher than the rate of inflation at the time, which was 7.9%. And now nearly everything down on a year over year basis and below that rate of CPI, which is 6%. So this is probably the main reason why I think the next few inflation prints are going to be pretty good ones, because you're going to see these comparisons, especially in terms of heating oil and natural gas filtering in, and obviously gas prices. All of these components are going to be pushing that inflation rate lower, whereas a year ago they were helping to push it higher. So very good thing to see for everyone. We need some inflation relief. We can talk about why this is happening, and part of it, of course, is that the economy is slowing, not just the U.S. economy but global economy. But this is a necessary thing that we needed to occur to start to get inflation in check. So a good thing to see, and hopefully it continues. So I want to end it right there. Have a great week, everyone. If you like the content, subscribe to the channel, and I'll see you next time. Thanks.